Hello and welcome to the Currency Exchange NatWest FX podcast, where we help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today, I'm joined by Paul Robson, who is our European G10 Head of Strategy and Research. And we'll be taking a deeper dive into European currencies and across the C3 this week. However, before I get started on that, the major data focus this week was for US CPI and what it meant for the dollar. It did not disappoint in terms of having a market reaction. Paul, what did you make of this week's US inflation release?
It was a very important release. I think this year is all going to be primarily about the dollar and Fed pricing, the sort of all-important first Fed cut, the depth, and ultimately the speed. So inflation is, a key part of that. In terms of the release, you did actually see a market reaction. The release showed inflation being a little bit stronger than expected. I say a little bit. We are down to sort of 2 decimal places in terms of the data, but the market reaction perhaps suggests that some were expecting a weaker number, the sort of whisper number, if you like, perhaps below the formal market expectation, and therefore we saw the biggest reaction. I don't think it changes the outlook greatly for Fed policy. I think really it's just about the difference between pricing for a March start of a Fed easing cycle from May, and we think that it's still going to be May. So for us, at least, it didn't change the outlook dramatically, but for some, it probably just chips away at market positioning.
And Paul, what does all this mean for the dollar?
Well, I think when we look at the dollar, I don't think it changes the outlook dramatically, but I think it does give you more confidence that the pullback in the dollar that we've seen this year can continue. So one of the key themes of the end of last year was the dollar was coming under quite a lot of pressure. It tends to come under pressure on a seasonal basis in December, and it unwinds that to some extent in January, and we were seeing that at the beginning of the year. And this slightly stronger than expected CPI number that, as I mentioned, perhaps just shifts the balance away from markets looking for that first all-important Fed cut to come in March, that comes later in May, and that's supportive. There were other parts of the recent data that I think are important for the dollar. We obviously had that payroll report last Friday, which was slightly stronger than expected. But one of the indicators that I like personally looking at is weekly initial jobless claims in the US. Now, it's not everyone's favorite indicator. It's weekly, it's volatile, it gets impacted by the weather, strikes, the timing of Christmas and deliveries, all kinds of things. But this indicator of employment sentiment in the US is completely in the wrong ballpark for a central bank that is thinking about easing monetary policy, if that's what they're doing, and thinking about sort of early this year. And it's not even a ballpark just down the road. This ballpark looks to be in another city. Initial claims bouncing along the lows. They should be rising. They should have been rising a long time ago to justify confidence that the Fed would ease aggressively. So for me personally, I think that's a key indication that the dollar stays relatively well supported at the beginning of the year until those Fed cuts come. And the other point for the dollar, and I think a lot of people miss this, is, and I'm always minded about FX being a relative business. It's about the US. Yes, the US is slowing. Inflation is sort of coming lower. The economy is weakening. But the economies of a lot of countries around the world are doing particularly poorly. Inflation's coming down everywhere. Growth and activity is weak. And I think for the dollar to turn meaningfully lower, the rest of the world is going to have to do more of the heavy lifting. So if we were getting softer inflation data and activity at the same time as the rest of the world was doing relatively well, then that would be a more obvious negative for the dollar. But that's just not the case. So the data that we're seeing, both inflation and some of the jobs numbers, just give us confidence that it's too early to look for the dollar to go down in a straight line immediately from here.
I know markets definitely towards the end of the year were getting quite dovishly ahead of themselves. And we certainly saw some of that bond market FOMO coming out to play. I guess turning closer to home, we've had a lot of ECB central bank speakers this week and also kind of softer growth and inflation data. I mean, what were your key takeaways from this?
Well, I think the key takeaway from the Fed, the actual ECB speakers, I think it's more about the centre of gravity on the governing council of the ECB. I think it is moving more to the dovish side. I think that the arguments for the doves on the committee, it's just becoming a little bit easier. It's being supported by the dollar, by the data, and by the sort of inflation data in particular. And the arguments that are put forward by the hawks are just becoming a little bit harder. So when we think about the data that we're getting in terms of inflation in particular, well, the sort of run rate, the monthly run rates, when we annualize those up, are in line with the target of the ECB, around 2%. And they have been for the last couple of months at least. And against that backdrop, it's very hard to make the case that monetary policy needs to be the sort of degree of tightness that we're currently seeing. We don't need interest rates to be bearing down on an economy that is weak, and inflation is currently running around target. So I think it's supportive of the view that the ECB is going to be at the sort of vanguard of the global easing cycle. So we think the ECB goes first. We think the Fed goes sometime in the second quarter, and then other central banks follow up in the second half of the year. But that's certainly, I think, the key takeaways from the data, but also importantly, recent speakers.
And I guess what you're saying about the ECB going first, I mean, what does this imply for the euro?
Well, I think it means that the euro underperforms. I think that the currency has tracked interest rate expectations really quite tightly over the last sort of year to sort of 18 months. And if we're right and the ECB goes first, and I think it continues to underperform. And I think the euro will be one of the sort of underperformers in the European sphere of currencies. I think when we look at the outlook for the euro, I think we have to be also mindful about the growth outlook in Europe. And for me personally, I find it very hard to see what the sort of external growth driver of European growth is going to be. Traditionally, it's been global markets, it's been Asia. That doesn't look like it's going to come through. I think the transition to electrical vehicles, for example, is going to weigh on regional manufacturing, and you have the impact of manufacturing on the service sector as well. And so you get a combination of weak growth, low yield, and the euro continues to underperform. So, euro sterling lower, euro stocky, euro NOK lower. The currencies that might do not so well against the euro, things like the Swiss franc. And I also know that, not to steal some of your thunder, but I know that you've got quite a lot of differentiation within the C3 region as well, which I think is going to be a fascinating area to watch as we move through 2024.
Yeah, and I guess picking up what you're saying about sterling, kind of moving closer to home, it's been relatively a lot more quiet for the UK this week. We did have Governor Daly testifying, and I think we're waiting on the GDP print later this week. But are you still relatively bullish on sterling? What's your view here?
Yeah, relative constructive on the currency. I think, as I said, euro sterling lower. I think cable sterling dollar will be basing here. I thought it's very interesting. You mentioned Governor Bailey's comments. He was testifying to Parliament on financial stability. So monetary policy wasn't an obvious topic to sort of talk about in front of politicians, but he was making the point. And I think this is really important, actually. He was making the point about worries about global supply chains again, not necessarily that the goods aren't being manufactured like they weren't being manufactured in COVID, but being transported around the world. And why that's important for the UK and sterling is that inflation in the UK has come down over the last sort of 6 months or so, but it's been goods price inflation that has driven that, and service sector inflation has been relatively resilient, and that supports the idea that the Bank of England sort of is one of the laggards in terms of easing monetary policy, and that's why we think sterling does relatively well. But if we get sort of global inflation again in terms of goods, that's only going to make you more confident that the Bank of England isn't cutting even in the second half of the year, for example, and that can support the currency as well. For the currency as well, I think just looking through peak pessimism around UK growth, there was plenty of stories at the end of last year, whereas people were talking about the outlook for the UK being poor, but it's poor in a number of major economies. So on a relative basis, perhaps UK assets are perceived to be relatively cheap. And if that demand is coming from abroad, that means that you get some support for the currency as well. And I think that's important. And then just finally, a third point for supporting our sort of constructive view on the currency. We just think that over the last 2 years, the UK has sort of transitioned to being just like a more normal economy. Some of the Pacific risks around the outlook have gradually just been ticked off. And so the outlook feels very much more about yield and growth. And as I said, the yield environment looks like it's going to be supportive, and the growth environment it's average. And so yields dominate, supports the currency. And we think, as I said, euro staying lower and maybe support for sterling dollar.
Just picking up what you were saying there about, yields, you can definitely see that play out, that we're still in an environment where it's really kind of relative central bank policy. And it's those central banks that, kind of hold out the longest or ease the slowest, whose currency should really be supportive. And definitely in my space within Central and Eastern Europe, you can really see that. So we've had kind of political pandemonium in Poland this week, where, it's really kind of this new pro-EU government who is trying to unwind kind of 8 years of very populist nationalist rule. And the opposition party are really kind of digging in and kind of, really looking to undermine their control of power. And yet the Polish zloty has, remained incredibly resilient. Actually, week to date, it's outperformed its CE3 peers. And that's really all down to the central bank. So it doesn't matter if you have, what politicians are calling a potential constitutional crisis, but if your central bank is saying that it's going to move extremely cautiously, it's actually refused to say, whether it's in an easing cycle or not, that really underpins your currency. I think, given what's happening in Poland, we think that central bank policy needs to stay extremely tight. On the one hand, that's because, this government needs to ensure that it consolidates its power. They're going into a presidential election in 2025. That their candidate wins that office of power, and therefore fiscal policy will be easier. And it's also about, restoring kind of investor confidence. They're very much focused on the currency and yields. They do not want to jump in yields, which is going to make their borrowing costs even more punitively expensive. So we certainly think that, the Polish central bank will continue to keep policy very restrictive, and that should really underpin the currency, even in spite of what's going on politically. That's probably about all we have time for this week. We've definitely done a broad coverage across Europe. Paul, thank you so much for giving us your insights. If you do like the podcast, make sure you click subscribe and do click like as well. Thank you very much.